As of June 25, 2024, the total market cap of all listed banks and small cap finance banks in India was about 52 lakh crore. The top three banks by market cap, HDFC Bank, ICICI Bank and SBI, together had a market cap of about 29 lakh crore. So that's 56% of the total market cap. And it's not just the market cap. These three banks constitute about 52% of the net profit of all listed banks. What's more, their combined net profit is more than the combined net profit of all other listed banks and small finance banks. And for this reason, it wouldn't be wrong to say that these three banks aren't just the bellwethers of the Indian banking sector, but they also hold a prime position in India's economy. Now, if you are a stock investor, which of these three banks should be part of your portfolio, or do all three deserve a berth? Hello and welcome to ET Money's YouTube channel. Today, we are going to compare the giants of Indian banking, HDFC Bank, ICICI Bank and SBI. After watching this video, you will have a complete idea of these banks' strengths and weaknesses so that you can pick the best one for your portfolio. But an important reminder first, please subscribe to this channel if you aren't already a subscriber and click on the bell icon so you never miss a video from us. And yes, don't forget to like and comment. That will help this video reach far and wide. Alright, this face-off video is divided into certain sections. In each section, we will look at few metrics and compare the three banks across them. You can even use the metrics and the comparative framework discussed in this video to analyze and compare any other bank. So let's begin with a little history of the three banks. So this is going to be a short tour of the history of HDFC Bank, ICICI Bank and SBI. As an investor, it helps to learn about the legacy of a company, but if you aren't a history fan, feel free to jump to the next section by clicking on the timestamp in the description of this video. Alright, let's start with HDFC Bank. The history of HDFC Bank starts with HDFC Limited or Housing Development Finance Corporation. HDFC Limited was founded in 1977 by late Shri H.D. Parekh. In 1994, HDFC got approval from the RBI to set up a bank, and that's how the HDFC Bank was incorporated in August 1994. In 2000, Times Bank and in 2008, Centurion Bank of Punjab were merged with HDFC Bank. However, the watershed event in the bank's history was its merger with its parent company HDFC Limited in 2023, after which HDFC Limited ceased to exist. Next comes ICICI Bank. ICICI Bank's history starts with ICICI or Industrial Credit and Investment Corporation of India, which was started in 1955 to provide project financing to Indian businesses. ICICI Bank was incorporated in 1994 as part of the ICICI Group. In 2001, ICICI and ICICI Bank merged into a single entity. So like HDFC Bank, ICICI Bank also came into being in 1994 amid liberalization. However, unlike HDFC Bank, which recently merged with its parent, the merger of ICICI and ICICI Bank happened about 23 years ago. And finally comes SBI. SBI's history goes back over 200 years to 1806 when the Bank of Calcutta was founded. Later, it was renamed the Bank of Bengal. In 1921, the Bank of Bengal was amalgamated with the Bank of Madras and the Bank of Bombay to form the Imperial Bank of India. Now, the Imperial Bank of India was a giant of its time, serving the triple roles of a commercial bank, a banker's bank, and a banker to the government. Now, when RBI came into being in 1935, the Imperial Bank stopped being the country's quasi-central bank, though it continued to handle many central bank functions for the years to come. After independence, a state-sponsored bank was needed to serve the economy, especially the rural sectors. Consequently, the Imperial Bank was taken over and constituted as State Bank of India in 1955. So in terms of history, SBI has a clear edge. Not only has it played a pivotal role in India's history, but it's also finely interwoven in the India's economic fabric. Alright, let's now compare the loan portfolios of the three banks. A look at the loan portfolio can help assess a bank's orientation. For instance, about half of HDFC loan book is for retail customers, corporate constitutes 20%, and commercial and rural banking make up the rest 31%. The commercial and rural banking vertical of HDFC Bank includes loans to MSMEs, emerging corporates, commercial agriculture, small and marginal farmers, healthcare finance, equipment finance, and commercial transport companies. This vertical also helps the bank meet its priority sector lending requirements. Now, as far as ICICI Bank is concerned, more than half of its loan book is retail in nature. Corporates constitute about 21%. Finally, in the case of SBI, retail is 42% and the corporate share is 35%. Now, how does this comparison help? Well, SBI is a better play on corporates than HDFC Bank and ICICI Bank. Amid a booming economy, as corporates do well, SBI is likely to do better. On the other hand, HDFC Bank and ICICI Bank's comparatively large retail exposure makes them more stable. Now that's because retail loans tend to be less lumpy, so a few bad loans don't badly damage the bank's books. Alright, let's now compare the sizes of the three banks. Now a number of metrics can be used to measure size. At the beginning of the video, we talked about the market cap, so that's one metric. But in the case of banks, it's worthwhile to check the size of the balance sheet or the assets part of the balance sheet. That's because the major source of income for banks is loans, and loans belong to the asset sides of the balance sheet. It's also useful to take a look at the deposits and advances. Deposits are depositors' funds and advances are loans that a bank has given. Now, while HDFC Bank is at the top in terms of market cap, the situation quickly changes in terms of assets, advances, and deposits, and SBI emerges as the biggest bank. It's 2 to 3 times bigger than both HDFC Bank and ICICI Bank. Now, after its merger with HDFC Limited, HDFC Bank has also gained enormously in size as compared to ICICI Bank. Its assets, advances, and deposits are about twice those of ICICI Bank. Now, in terms of branches, SBI's reach is about 2 to 3 times its peers. So, as far as size is concerned, SBI is the undisputed winner, followed by HDFC Bank and ICICI Bank. Alright, let's now move to the next metric, which is growth. Like size, we will consider a few metrics for measuring growth as well. These are growth in deposits, advances, net interest income, and profit after tax. Now, we discussed deposits and advances in the previous section, and profit after tax is a no-brainer. So let's have a word about net interest income, or NII. NII is an important banking metric. It is the difference between interest earned and interest expended. A bank earns interest from its lending operations and has to pay interest on its deposits. NII is the difference between this income and expenditure. Now, NII is also loosely called a banker's revenue, but it's not exactly so, as banks also have other sources of income. Similarly, interest paid isn't the only expense for a bank. There are other operational expenses as well. Still, NII is a useful metric to gauge the performance of a bank's core activity. Now, in terms of growth and advances of deposits, HDFC Bank is the winner. But let's not forget the impact of the HDFC Limited merger with the bank. ICICI Bank is the topper in terms of NII and PAT growth. Overall, ICICI Bank and HDFC Bank seem to be doing better than SBI in terms of growth. Alright, let's now talk about efficiency. For efficiency, we will consider metrics like net interest margins, the CASA ratio, and the cost to income ratio. Now, I understand these may sound like alien terms, so let me explain them first. In terms of banks, net interest margins, or NIMs, are the equivalent of operating margins. It is calculated by dividing the net interest income, or NII, by average earnings assets. We discussed NII in the previous section, so let me give you an example of NIM calculation. Let's say a bank has an NII of 1000 crores and its average earning assets are 25,000 crores. So the NIM will be 4%. Now, the higher the NIM, the better. It indicates that a bank has a superior margin profile. Next comes the CASA ratio. CASA stands for current account savings account. The CASA ratio calculates the proportion of such deposits in the overall deposits of a bank. CASA deposits are important as they are low cost deposits. So a bank's profitability tends to improve. It has more low cost deposits. Then comes the cost to income ratio. It is derived by dividing the operating expenses by the operating income. In the case of banks, operating income is NII plus other income. Now the cost to income ratio helps assess the efficiency of a bank's operations. The lower this ratio, the better. Alright, let's now see these metrics: NIMs, CASA ratio and cost to income ratio for the three banks. Now because NIM is a crucial metric, let's see this historical trend too. Now something interesting happens here. Post merger in 2023, the NIMs of HDFC Bank have fallen sharply. On the other hand, ICICI Bank has shown a steady improvement in the NIMs. SBI has been a laggard as far as this metric is concerned. Let's now see the average values of the other two metrics, CASA ratio and cost to income ratio. Now, as far as CASA ratio is concerned, there isn't much difference. However, the cost to income ratio is heavily tilted in favor of HDFC Bank. But wait, before you jump to a conclusion here, averages tend to hide the details. Let's see the HDFC Bank's historical cost to income ratio. There is a sharp jump in HDFC Bank's cost to income ratio post 2023 after its merger with HDFC Limited. So, as far as efficiency metrics are concerned, NIM seem to be favor ICICI Bank, the CASA ratio is a non-differentiator, and the cost to income ratio is in favor of HDFC Bank in average terms. But it remains to be seen if HDFC Bank can do something about the sudden rise in its cost post the merger. For now, it appears that it can lose its cost advantage over its peers. Alright, let's now compare the quality quotient of these three banks. To assess quality, we use three metrics: NPAs or non-performing assets, return on equity and return on assets. Let's first understand why these metrics matter. In simpler terms, NPAs are bad loans. A loan whose installment of interest and or principal hasn't been paid in 90 days becomes an NPA. Now, banks have their ways of dealing with NPAs, but from an investment perspective, you should be extremely watchful of NPAs in a bank. Like NIMs, NPAs are a very important metric to track. So let's see the historic NPAs of the three banks. HDFC Bank historically has the least NPAs as compared to ICICI Bank and SBI, though the NPAs of ICICI Bank and SBI have seen a sharp fall over the years. Here, we are talking about gross NPAs. Gross NPAs are NPAs prior to provisioning. And what's provisioning? Well, provisioning means setting aside an amount to counter the effect of NPAs. The other popular NPA metric is net NPAs, which are NPAs post provisioning. But to know the real picture of NPAs, checking gross NPAs is better. So HDFC Bank has a clear upper edge in terms of gross NPAs. Next comes the return on equity and return on assets. Now, return on equity is a classic profitability metric that is obtained by dividing the net profit by shareholders' funds or equity. Now, return on assets is a profitability measure too, but it's more relevant for banks as banks have asset-heavy balance sheet. Let's check the 5-year averages of these two metrics in case of the three banks. In terms of both ROE and ROA, HDFC Bank does the best. ICICI comes next and SBI at the end. But when we check the 3-year average, the situation changes a bit. Both ICICI Bank and SBI have done better in terms of ROE over the last 3 years. The ROA performance of these two banks have also improved in recent years. So while HDFC Bank has historically had an edge in terms of quality, both ICICI and SBI are fast catching up with it. Alright, let's now move to the last measure, stock performance and valuations. Let's first check the trailing returns of the three bank stocks. Over the 5 years and longer, ICICI Bank has done better than HDFC Bank and SBI, but over shorter periods, SBI has done better. Now, the likely reasons for this is the strong recovery SBI has seen in its performance post the NPA cleanup a couple of years ago. Overall, ICICI Bank and SBI have done better than HDFC. Due to its muted returns, HDFC Bank has disappointed the investors over the last 5 years. Alright, let's check the dividends for the three companies too. SBI has the best dividend yield as compared to other two banks. HDFC Bank comes second and ICICI Bank is at last. The dividend yield is obtained by dividing the dividend amount by the stock price. Now, this metric is used to compare dividends across stocks as it reflects the dividend amount in terms of its respective stock prices. Finally, let's check the valuations of the three bank stocks. Now, since banks are asset-heavy businesses, it's better to check the price to book ratio or the PB ratio for them. It's also worthwhile to compare the PB ratio with the historical median to get an idea about how cheap a stock presently is. Now, if we compare the three banks with each other, ICICI Bank is the most expensively valued at the moment and SBI is the least. Now, PSU banks tend to trade cheaper than their private peers, so SBI has historically been cheaper too. But if we compare each bank's valuation vis-a-vis its historical median, HDFC Bank is at a discount and the other two banks are at a premium. In particular, SBI is at a steep premium to its median PB. Now, these valuations tell us about the recent performance of the three banks too. As ICICI and SBI have started doing well over the last couple of years, their valuations have started to go up as well. On the other hand, as HDFC Bank's performance metrics have slowed, its valuation metrics have also dipped. So, given all the metrics, which is the best bank of the three? Well, this is not something I can tell you. I have presented all the data to you, and now as an intelligent viewer, it's your turn to tell us and your fellow viewers which bank is the best in your opinion and why. So do post a comment, and based on your comments, the best bank will be decided. Your time starts now. And with this, we have come to the end of this video. I hope you found this video useful, and if you did, please don't forget to share it with your friends and family. I'll see you again with another video. Till then, take care.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.